we're still looking at multifamily. We're still open to, there's some situations that make a lot of sense, but we've also looked at other investments that are real cash flow investments. And I feel like when you have a cash flow investment that cash flows from day one or very quickly, it reduces your basis because you're able to start getting money back very quickly. And so that's why you're looking at businesses or car washes or ATMs or oil and gas or other things that can cash flow a little easier. I think those are a little bit of an easier sell now. And I think what a lot of people don't realize now, Michael, is that there's also a risk, not just of, hey, I'm going to wait and kind of, the confused mind will say to wait, but inflation is still a big risk.
Bronson, welcome to the show.
Hey, Michael, Garrett, super excited to be here and I've always loved your show, man. It's been awesome over the years. You've just done an amazing job.
Yeah, well, it's great. It's been a little while since we connected. We worked together for a good period of time here, and it's great to see your success on Bronson Equity and doing the stuff you've done and raising millions of dollars. It's really cool. So it's great to check in. So just provide a little bit of background. I mean, your background is like so many of us, this journey to financial freedom. So talk a little bit about how that went for you.
Yeah, so I was a well-paid medical sales professional, was making over 200K a year, was getting paid well. A lot of people in the medical field do very well financially. But one of the issues is it's very hard to take time off, and I didn't have control over my time. And a lot of people think of financial freedom, but really they're thinking in terms of when you really break it down, it's time freedom. And I wanted to have the ability to travel, the ability to create, and I just didn't have the ability to do it. So I decided I wanted to get more into real estate and really develop, as Warren Buffett would say, learning how to make money while you sleep. So that was kind of the reason why I decided to journey into real estate.
So how'd you go about pursuing it, right? Because I mean, it took me 10 years and millions of dollars lost to kind of find it. And your path was a little more direct. How did you go about it?
Yeah, so I kind of read everything I could on real estate. I started doing single family stuff and realized, just as you say a lot, is single family does not get you to financial freedom. So I discovered that pretty quickly. And then I had a cousin who was doing multifamily. He said, "Why don't you do multifamily investing?" And I said, "Well, that sounds great, but I don't have the money." And he said, "Well, you can raise the money." He talked about the thing called syndication. He actually recommended your podcast and some other events and things. And I remember when I actually met you, Michael, I actually came up and I'm a little bit gregarious sometimes. And I came up and I was all excited. "Hey, Michael, how's it going?" Like almost as if we'd you knew me from whenever. You didn't really know who I was, but I'd spent all this time with you through your podcast. And so anyway, basically had raised some money for a deal, for a multifamily deal, 100K for a deal in Texas. And then just was really, pursuing it, trying to look at deals, trying to figure out how to raise money. And then from a partnership, that's actually you and I started working together and the team started working together and we raised a lot of money, tens of millions of dollars over the next, year and a half. And it just gave me the chance to get on the phone with a lot of high net worth investors. So I took about 1,000 one-on-one phone calls with high net worth investors while still working my full-time job. So I was doing those at 6 a.m. at lunch and in the car. I was doing them kind of whenever I could just to try to get the experience and really bring the value.
Yeah, absolutely. Now, so we worked together. We were participating in our platform, on our podcast, and our videos. You spoke to a lot of our investors, and then you went out on your own, and you really built this amazing platform. Talk a little bit about the elements of your marketing platform. So, what did you do, and how have you leveraged it to raise more capital? Because really, what you've done is you can raise $500,000, $1 million, through word of mouth, one-on-one meetings, and you wanted to kind of do it through a platform. So, what did that look like for you?
Yeah, so honestly, just seeing people like yourself and other successful investors and entrepreneurs, just see when you have a platform, it goes from the one-to-one to the one-to-many. And I always told myself like, "Oh, I'm not a tech guy, or I'm not I'm not somebody who can do that, whatever." But then I realized that was kind of a negative self-talk, and I said, "No, I've got to learn this. I got to do whatever it takes to learn how to create events and podcasts." So we started a podcast called the Mailbox Money Show. We have kind of a virtual panels every month where we'll have 100, 200 people show up. And it's just been really great to create this kind of one-to-many. And really, the person I'm trying to reach typically is a professional or a business owner who's trying to reduce taxes. They're trying to grow their passive cash flow. They're trying to find ways to, get to financial freedom. Maybe they make a lot of money, but they don't have time freedom. And so, I think, and recently writing a book, that's another way too, just to try to reach more people. But it is really amazing in our culture today. You don't have to just go to a bunch of events, and I like events, but when you can just put things out there that people can share and they like, and you really create something that's a valuable, valuable as far as content, people can take it and run with it and share it, and it just gets your word out without having to have all those conversations individually.
Yeah, speaking of book, you did mention your book called Fire Yourself. And what's the book about, and kind of what was behind you creating? Because I know from personal experience, it's a lot of work. It's a huge commitment to write a book. And so what was behind that?
Yeah, so yeah, it was interesting. Writing the process of writing a book is a lot of work, and but it's something if you just take the time and you sit out and you do it, you can. The reason I wrote it is I wanted to fire myself. I wanted to get to a place where I didn't have to go to work, that I had control over my time. And I was able to do it last year, or actually this year in 2023. I was able to travel 6 times internationally. I was able to raise, close to $15 million. And it's just, when you can do things that you can create in your life, whether it's through active investing. This book is really dedicated more to passive investors of how do I start investing in things outside of Wall Street or things that can put money in my pocket every month. So it talks about how to develop cash flow streams, how to vet deals, not just in real estate, but also in other alternative assets. How do you find great deals? How do you find partners? And really, how do you get in that process where it's like a muscle, right? A lot of people that I've talked to and worked with, until they've invested in a deal, everything just sounds like a foreign language or a foreign concept. But once they actually put $100,000 in a deal, or they put some money in a deal, they get some experience with it. It's like a muscle they start to flex, and then over time they're like, "Hey, this really works." They can scale it up, and they can really see the benefit of saying, "Hey, I actually get gotten to a place where I can leave my job if I want to," which is huge. You don't necessarily have to leave your job if you have a job you like or a business you enjoy, but if you want to, or you sell your business, there is a way, as Warren Buffett would say, to make money while you sleep.
Yeah, so Bronson, a lot of what you're doing now, it's you've kind of we were working together and you've branched off to do your own thing, and you've really built a name for yourself. You're now going and picking different verticals, it seems like you're branching more into private equity when it comes to potentially capital raising. How are you going about vetting sponsors? Like, what is that process like to make sure that they're not doing something crazy when you go to place capital?
Yeah, it's a good question. I think there are some common things when it comes to vetting deals, and a sponsor is obviously a big part of that. I look for really, when you have a call, typically when you join somebody's investment group, you'll have a call with somebody on the team, like all those calls I have with investors. But just really trying to figure out what the values of the team are, like what's important, what do they say, what's on their website. If you can talk to other investors, especially. I think three of us are kind of industry insiders, so people kind of get to know who's doing what in the space and how things are generally going, and there's a reputation that goes with that. I also do, when I have other partners and other things, I always do a background check to make sure that at least there's something that if there's anything glaring there, that we see that. And then sometimes I'll invest my own capital first. This is how it worked with our ATM fund. I invested first as a passive investor, and then after a year or two, I was like, I really like this investment. Maybe I'll look at seeing if I could bring my investors to this deal. And so, but it's always, whenever you work with partners, whenever you bring deals to investors, it always feels like quite a big, it's a lot to do that. And so you just want to make sure that the values, the focus, where people are going, kind of the direction, they doing this a long time? Do they have a track record? Also, a question I love to ask is, what's something that didn't go well in a deal? And if people, don't have anything to say, or they say everything's gone fine, usually they're inexperienced, or they're just not being fully transparent. Because in every deal, as you guys know, even, multifamily deals, like there's things that go well, things that don't go as well, and you learn. There's like a learning process, as you work along. So I think, as far as that goes, I love to passively invest first, but other times through reputation or through an introduction, or just through really feeling like, hey, does this group really match up with really our core values, and are they really going where we're trying to help our investors go? And same with working with passive investors, we'll look for a long-term relationship with our partners that we work with on the investment side, or even on the passive side.
How do you get up to speed on the business? So like ATM funds, like if I haven't done anything with that, I have no clue like how to go and do that. How do you kind of like learn what that business is all about if you're not investing with them?
Yeah, so it's a really good question. I think as an investor, Warren Buffett, I draw a lot from Warren Buffett, but he says, we don't invest in anything we don't understand. And so for a long time, he didn't invest in tech stuff. He didn't invest in, there's certain things like I just don't understand, or I'm not excited about. There's no passion. There's no, like, I just don't get how this works. But like with ATMs, it's like, okay, well, I try to always find out, like, what are the primary risks of an ATM deal? Okay, well, generally it's, well, people stop using cash. Will that slow down? And well, what are the facts? What's the data say? And that actually shows that the number of ATM transactions are actually increasing about 4% per year, historically, and then going forward. So there's things that you try to look at, just ask continual questions about, okay, what does this industry look like? What are the biggest challenges? And then I'll ask, kind of get in my mind what I think the biggest risk is. And then when I talk to the operator, I'll say, what do you perceive as kind of being the biggest risk here? Or if I talk to other investors, I'll say, well, what are some things that you considered going into this? Or what are some concerns you have? Or what's the communication like? So I think those are all things that, you don't know what you don't know, but I think if you ask questions, if you do some research online, I mean, now you can Google anything and you can just get on ChatGPT, what's the biggest risk of investing in an ATM deal, right? And it'll give you all this information. So I think, I think it's just to get, most businesses honestly are pretty straightforward in the sense of, okay, there are ways you can make money, there are ways you can lose money, and just trying to understand the best you can. And obviously too, if you have $10 million to invest, maybe put, the minimum in the first, when you first start. I don't put in, $5 million in the first deal. You put a little bit in, you kind of inch your way in and kind of get familiar with that asset class and that operator.
What are some of your main messages in the book? So you got, your message to the millions about passive investing. What do you have to say about that?
Yeah, well, the biggest thing is that a lot of people invest in ways they think are passive, but they're actually not. I know this is similar to your message as well, is that single family investing is not passive. If you can't 10x the current strategy that you're doing, so if you have 3 rental houses, if you couldn't go to 30 houses like overnight, if that just sounds overwhelming like a full-time job, you're not actually passive investing. If you actively trade stocks, you're not passive investing, because it's a lot of effort. And to have, it's different to invest a few $1,000s than to have like half your net worth in stocks where you're actively trading and you're in and out and you're doing things. So the idea of really passively investing, it is something that exists, but it doesn't exist in traditional finance. I used to be a registered investment advisor, which is an RIA. Now I'm still an RIA. It's a recovering investment advisor. So I kind of saw behind the curtain of some of the Wall Street stuff and just said, Wall Street gets paid no matter what, even if your investments go down by 50%, but there's a lot of misalignment of interest. They did a big study and they found that almost 60% of fund managers managing over $100 million in Wall Street had $0 invested in the funds that they invest in, right? So a lot of people that we know, a lot of people that are listening, and we have a money person that manages, our retirement or manages millions of dollars. But really, I just think it's far, far better if we can get out of Wall Street and into Main Street. And this is really a guide of how to do that. How do you look at different types of deals? How do you vet different types of deals? How do you get control over your time? If I have a business and I'm selling it for, a few $1,000,000 or whatever, what am I going to do at that point? How am I going to generate cash with, do I just put it in treasuries? What if there's no yield? Like, what are the things that I can do that really can create a solid return of 10, 15, 20% per year? And those things are out there. It just takes some work and some effort and really investing in your own education.
What are some of the more common mistakes that you see passive investors make?
I think there's a few. I think one of the biggest ones is analysis paralysis. I see a lot of people kind of look at syndicated deals and they just kind of keep looking at deals and they never really make a decision. And so kind of how I confront that, a lot of times I tell people, even in the book, I say, make a plan that you're going to invest in a deal in the next 30 days or the next 60 days, and set a timeline. And if you don't, tell your friend, hey, I'm gonna pay you $500, or I'm gonna give you some sort of deadline. And then look at 5 or 10 deals. Don't look at like a million deals. Just look at like 5 or 10 deals and then choose one and do it. And probably it'll go just fine. You'll learn a lot. And really, I think it's the education more than how the investment does itself. I mean, obviously, preservation of capital is very, very important, but what you learn along the way, I think, is even more important. And so I think that's a real critical thing, real critical thing to consider.
So analysis paralysis is definitely something that you see a lot. Anything else that stands out?
Yeah, I think, again, a lot of times there's people that it's kind of tied in with analysis paralysis a little bit, but there's a lot of people that have a lot of big, lofty plans and dreams. And I don't know if you guys have done amazing things in your life. Garrett, Michael, you guys are just admire you guys a ton. But there came a point in my life where was turning 40 and I just said, I've got these dreams in my heart. I want to really go for it. Or even when I was getting ready to quit my job, I didn't have to quit my job. My family was like, you're absolutely crazy. Why would you quit your 200K a year job? You're doing this in like 30 hours a week. Like, why would you do that? But there's that quote that says at the end of your life, you'll regret more the things you didn't do than the things that you did. And so I just think it's like really going after your dreams, really doing the things you're here to do. And when you're financially free, it allows you to do that. And I know, Michael, you talk a lot about that too. Once you become financially free, it comes down to your legacy. What's the legacy that you want to leave? And so the last chapter in here is about what do you want to leave behind, what's your family? For me, my big why is really ending modern day human slavery in the world. And so just, finding a way to use finances to really help make the difference in the world that you want to see. So I think, the things that hold people back, I think it's people feel inexperienced. If there's two people, one has great ideas and they just have great theories and they have this incredibly detailed plan, and the other person doesn't really have a lot of plan. They just have kind of a goal, but they take a lot of action. The person that takes the action will almost always beat the other person because the other person is all in theory, right? So if I just simply start taking action, so if somebody's a passive investor or wants to be, doing apartment deals or other types of deals, if you just start going to meetups, you start reading books, you start taking the action, start looking at deals, it's just amazing what can open up to you. Everything starts to open up and then you learn as you go along.
Right now is a very difficult time to raise capital, right? I mean, there's bad news about foreclosures. Then there's, capital calls. Um, but this is really, how do you assess that? So these are people who have invested previously and they're getting burned right now, right? And so now you get this great opportunity and you're asked them to invest in this great opportunity and they're like, well, I'm just still licking my wounds from the last one. So how do you position that to your investor, right? How do you speak to your investors right now, especially when you have an opportunity, right? Because you have to somehow acknowledge that there is some pain out there, especially for people who have made investments. And so how do you position that?
Yeah, I think it's really interesting. It's very counterintuitive, right? The best time to invest is the time that a lot of people don't want to invest. I mean, looking back, the best time would have been between like 2008 and 2011 or whatever. It was a great time, but a lot of people were not interested in it. Or if like lately people have had capital calls or losses or it's actually the deals have gotten a lot better. But 2 years ago when we were raising, millions of dollars or tens of millions of dollars almost immediately, it actually looking back was a time of higher risk. And so what we try to tell investors now, and this is one of the reasons we've done, we're still looking at multifamily. We're still open to, there's some situations that make a lot of sense, but we've also looked at other investments that are real cash flow investments. And I feel like when you have a cash flow investment that cash flows from day one or very quickly, it reduces your basis because you're able to start getting money back very quickly. And so that's why you're looking at businesses or car washes or ATMs or oil and gas or other things that can cash flow a little easier. I think those are a little bit of an easier sell now. And I think what a lot of people don't realize now, Michael, is that there's also a risk, not just of, hey, I'm going to wait and kind of, the confused mind will say to wait, but inflation is still a big risk. And I don't think it's actually 3% like it officially is. I think it's more like 8%-ish. And so if that's the case, you're losing money just sitting there. We've seen that over the last 3 years. I mean, prices just about for groceries, just about everything seems to have just about gone up 50% in the last few years. So I think it's always important to kind of keep open, keep looking, to kind of realize, Warren Buffett's quote of "Be fearful when others are greedy, and be greedy when others are fearful." The best opportunities come when it's not a popular time to invest.
Yeah, it reminds me a lot of 2008. Honestly, it's in 2008, nine, no one was investing, right? There was blood in the streets, and that was the best time. That's when I started flipping houses, because I saw the opportunity, and I was like, I flipped as many as I could. I should have gotten an apartment building. So I didn't know any better at the time, but I think we're in a similar position right now, and I think the sophisticated investor must tell the difference between deals that were bought 2 years ago and deals that are being bought right now. Garrett, what do you think about that?
The reality is that we saw the defined peak, right? So the defined peak was literally sometime between February and March of 2022. We saw it kind of get to the highest pricing that it's ever been. And so from that, you can look at that and be like, okay, well, it's coming down from here. Now, we don't know where the bottom is, but we know that deals oftentimes, just in general across the market, at least in our industry, multifamily, are down 30, 40, sometimes 50%, depending on where you're purchasing. Cap rates have blown out to between 6 and 7%. So you can pinpoint uh, that exact moment in time, which I think is super important looking ahead. Now, the problem is people are going to be getting burned along the way from there was this huge frenzy. Everybody got in. Those people are going to start getting burned. So they're going to be skittish. They just took a loss, or they took a partial loss, or whatever it was. They didn't make any money, lost money. So getting them to understand this and come back and kind of double back into it, that's what I'm curious, Bronson. What does that messaging look like for you?
Yeah, I think well, I think the big thing, and this is something I heard from Michael over the years too, is just, in any market, there's always opportunity. And I think that we're not looking at quite the same deal, at least we're not the same multifamily deal that we were looking at a little while ago. The debt situation has gotten difficult. And we're, deals that we are in, if they're below 90%, sometimes the rates the buyers are getting are 9 to 12% as far as bridge, right? So it's really tricky. So the situations I think we look at are, if there's some sort of loan assumption thing that we got 8 years left on a fixed rate thing, or, you can get it 3 or 4%. Some of those things are interesting, but those are, they come with a premium, and those are hard. And that actually would have been a business there, right? Of just having fixed rate debt and then being able to, have people assume those and sell them off. But yeah, I think it's definitely changed. I think that, we are seeing in the pricing where, in Atlanta, we have a property there, and one of the brokers was saying from the peak in 2022 to now, the pricing for that exact same property has gone down 42% in this one submarket of Atlanta, right?
Mhm.
That's brutal. Like, no matter what you do, it's like that's a really hard thing to work from. But then again, I mean, the plus side of that is prices are down 42%. And what happens if rates are a little higher now? You get into something now, it's better. Your buying price is fixed, but you can always refinance later into a lower debt, right? So that's what we're wondering. Everybody's kind of
Mm.
wondering, will rates come down? They're starting to come down a little bit. Will they come down next year? Will the Fed lower? We're not sure, but it's something to consider.
Yeah, I mean, look, I mean, the properties that are in trouble right now are typically the floating rate bridge loans, right? And people are like, "Whoa, why did you do those? Why did you?" Well, the simple answer is, well, you couldn't. You have to use a bridge loan to get into, if you're going to do value add by definition,
Yeah.
right? So there really wasn't any kind of way to avoid it. As the only way to do it, right? And so, but that's what's creating the problems right now. It's all anything related to construction. All construction projects that were bought with floating rate debt is, and it's very frustrating for me and a lot of other people that you are not really rewarded for good operations in this particular regard, because when you have interest rate caps expiring, even if you're at 93% occupied, it's not going to solve the problem. But you still have a massive problem. You're running out of cash. You don't have the cash to extend, and your exit now is very, very, very limited. And so,
Yeah,
from an operations perspective, that's super frustrating.
Yeah.
yeah, you have to make moves, actual capital market moves, when the capital markets are in the dumps, right? And anyone that was doing a construction project, you had a short-term loan essentially to get that done. And when you have to make a big move like a refinance or a sale or something along those lines to get out of that short-term loan, and then everything dumps out by 30, 40%, it causes real problems. And I don't think we've seen the amount of stress that still exists that's coming ahead. I don't think people have, you're seeing some of that, some people, losing deals or stopping this or whatever that's happening, but I think there's more to come. And it's challenging to predict exactly what the future looks like if you're going to buy deals right now too, on that side. What exit caps are you using? All those things. Now, I will say that because things are down so much, there's a higher likelihood that you're going to be winning, hopefully, if you operate well. Um, but still, the prediction, it's still murky. There's a lot of volatility going on in this exact moment in time when this is going to air.
So here's a question for you, Bronson. So let's say we expect 2024 is going to be rough for existing operators, but if you're a buyer, I think it's going to be magical, because you're going to be able to pick up stuff that's in distress, and that's going to have to sell quickly for a variety of. There's probably going to be loan modifications, short sales. So from a buy perspective, I think it's been great. Now for you, you've done multifamily, but you also have other asset classes. Now, are you going to stay away from multifamily because of that? Or if you do get into these opportunities that are going to be, I think, amazing, is that something that you're going to position to your investors? And if so, how are you going to do that?
Yeah, I think it's really interesting. I think this is something we talked about when we worked together. Is I remember having conversations with Garrett and be like, how much money do you think we can actually raise? Like it's like the unpredictable thing. You never know, right? And I approach it from a capital raiser size, like, well, if I raise for multifamily, how many can I raise 1 million or will it be 5 million? It's hard. It's really hard to know. So I think, in general, you can present if a deal makes sense, if it's a good deal, if it's conservative, you like it. I think a lot of investors these days are, anything bridge debt or value add is people are a little more cautious about. There's, we've looked at some senior housing or, senior assisted living kind of stuff that looks at new construction that looks interesting. There's other stuff out there that's great. I mean, if the deal makes sense and it's with a great operator, we're definitely going to consider it. But again, also considering what's the sentiment right now? And it's kind of the reality of it is like the deal could be the best deal in the world, but if you can't get the money for it, and even people that I know that are uber wealthy, a lot of them are tied up because they have money that are going out to different deals, or they've kind of had rescue things here or done they've done kind of different things. And so it's just something to consider. I think that there will come a point where it's just, we'll look back, I think, on this time and say, man, there were some great deals out
Yeah.
there right now that we just weren't able to take advantage of because it's hard to get the lending. But I do find with investors that are very sophisticated, some of the family office, more the private equity, the bigger groups, they are going pretty heavy into multifamily now because they see the
Mm.
opportunity, right? So resale investors, and I think you've talked about this, Michael, as well, of like, oh, it feels painful, so therefore multifamily is bad, versus like, well, no, like this deal maybe not have gone well, but it's actually a really great time with lower risk and a better long-term outlook right now. But it's the contrarian. You have to, as an individual, you've got to just go through that process and say, okay, well, what really is the risk right now? But one reality kind of on the other side of that is the wealth effect. People feel less wealthy, mostly people investing in multifamily, than they did 6 months, a year, 2 years ago. So those are just considerations. I'm not saying I think people that are savvy investors will find more moves to make. I'm seeing a lot less multifamily deals out there, but that means if you have a deal, there could be people that really would say, "Hey, this is a unique deal. That I like this. I like this time, this market." And so I'm definitely bullish on it. I think it's just finding the right deal that makes sense, and you see that there's low risk parameters in it.
Love it. Bronson, how can people connect with you?
Awesome, Michael. Well, thanks for having me, and thanks, Garrett. Yeah, you can go to my website, bronsonequity.com. I just wrote the book Fire Yourself, and you can get the first couple chapters for free on my website, so you can go download that. It's also available on Amazon, and I'm also on all the social medias.
That's awesome. So everyone check out Bronson's new book, Fire Yourself. Bronson, so great to have you on the show today.
Thanks so much, Michael. Thanks, Garrett. Appreciate you guys.